AI can read thousands of filings before you finish one page. It can analyze earnings calls, rank stocks, build portfolios, and execute trades in seconds. But here is the trap. Speed can scale insight or scale error. In this lecture, we uncover where AI creates real investment value, where it manufactures false precision, and why the final decision must still belong to a human. We will discuss one of the most important developments in modern investment practice: artificial intelligence in investment research, portfolio management, and trading. AI is changing how investment professionals collect information, process data, evaluate securities, build portfolios, and execute trades. But let me begin with a very important idea. AI isn't a magic replacement for investment judgment. It is a tool. A powerful tool, yes, but still a tool. Investment work has always required information, discipline, comparison, and careful judgment. Analysts compare companies. Portfolio managers compare expected return and risk. Traders compare speed, liquidity, and transaction costs. AI can help with many parts of this work because it can process large amounts of information quickly. It can summarize documents, classify text, detect patterns, rank securities, forecast risk, and support decisions. But AI can also create serious problems. It can create false confidence. It can hide weak data behind sophisticated output. It can produce forecasts that look precise but aren't economically meaningful. It can also make mistakes faster than a human analyst would. So throughout this lecture, our theme will be balance. We want to understand what AI can do, where it adds value, where it can mislead us, and why human accountability remains essential in finance. Let's begin by separating three terms that are often used together: artificial intelligence, machine learning, and data science. Artificial intelligence is the broadest concept. It refers to computational systems that perform tasks associated with human intelligence. These tasks include prediction, classification, pattern recognition, language processing, summarization, and recommendation. Machine learning is a subset of artificial intelligence. In machine learning, algorithms learn patterns from data. In investments, a machine learning model may be trained to predict future returns, classify credit risk, estimate volatility, identify earnings surprises, or judge whether a news article is positive or negative for a company. Data science is the broader process around the model. It includes collecting data, cleaning it, transforming it, modeling it, validating the results, and communicating the findings. In finance, data science must also include economic reasoning. A model may find a pattern, but the investment professional must ask whether that pattern makes sense. Think of the predictive setup as a disciplined way of saying, we use information available today to form a forecast about an uncertain future outcome. That distinction matters. A forecast isn't a fact. A model output isn't an investment decision. The real question is whether the forecast is accurate enough, stable enough, and useful enough to improve decisions after considering risk, costs, taxes, liquidity, and implementation limits. AI applications in investments should follow a disciplined pipeline. The first step isn't choosing the most advanced algorithm. The first step is defining the investment decision. Are we trying to select securities, allocate a portfolio, monitor risk, improve trade execution, support client recommendations, summarize research material? Each decision requires a different type of model, a different target, and a different evaluation method. After the decision is defined, we define the target. The target might be a future return, a risk classification, a volatility estimate, a credit event, an earnings surprise, a liquidity measure, or a drawdown risk indicator. Then we collect data. Investment data may include prices, fundamentals, analyst estimates, filings, transcripts, news, macroeconomic variables, and alternative data. But collecting data is only the beginning. The data must be cleaned, aligned through time, checked for missing values, and protected against look-ahead bias. Next comes model training. The model learns from historical data. But training performance isn't enough. We must validate the model on data it didn't use during training. Then, if the model is connected to a strategy, we backtest the process using realistic trading rules, costs, liquidity assumptions, position limits, and risk controls. Finally, the model must be deployed with governance. That means monitoring performance, documenting assumptions, reviewing unusual outputs, and keeping human accountability. A simple model connected to a clear investment decision is often more useful than a complex model solving the wrong problem. Now let's compare traditional quantitative models with machine learning models. Traditional quantitative finance usually begins with theory, intuition, or a clearly specified relationship. For example, a factor model may ask how much of a security's return is explained by exposure to market, size, value, momentum, or other risk factors. These models are often easier to interpret because the variables are chosen deliberately. Machine learning models often begin with a larger set of possible predictors. Instead of specifying a simple relationship in advance, the model searches for patterns, nonlinear effects, and interactions among variables. This flexibility can be useful, especially when the investment universe is large or the data is complex. But flexibility has a cost. Machine learning models can overfit. They can find patterns in historical noise. They can produce rankings that work in a backtest but fail when market conditions change. They can also be harder to explain to clients, committees, traders, and regulators. This doesn't mean one approach is always better. In strong investment processes, traditional finance and machine learning often work together. Financial theory can help select economically meaningful variables. Machine learning can then help model complex relationships among those variables. A very important lesson is this: prediction isn't the same as investment value. A model may predict something with some accuracy and still fail to create value. The signal may be too small, too crowded, too costly to trade, or already reflected in prices. So, model performance must be judged in two ways: statistically and economically. The model must not only appear accurate, it must improve real investment decisions. AI depends heavily on data, so let's discuss structured data, unstructured data, and alternative data. Structured data is arranged in rows, columns, fields, and consistent units. In investments, structured data includes prices, returns, volume, market capitalization, earnings, debt ratios, analyst estimates, credit spreads, and option implied volatility. This type of data is often easier to validate because the variables are clearly defined. Unstructured data doesn't fit neatly into a spreadsheet. It includes annual reports, earnings call transcripts, news articles, research notes, social media posts, patents, product reviews, audio, and images. This type of data can be very valuable because it may contain information before that information appears in standardized financial variables. But unstructured data requires careful processing. A transcript, for example, isn't automatically useful to a model. The analyst must decide what to measure: tone, uncertainty, topics, changes from previous language, analyst questions, management emphasis, or risk related wording. Alternative data refers to information outside traditional market data, accounting data, analyst estimates, and macroeconomic releases. It may include web traffic, app usage, shipping activity, job postings, consumer reviews, geolocation aggregates, product pricing, supply chain information, or satellite based observations. Alternative data can provide timely evidence, but it also creates challenges. We must consider legality, permissions, privacy, representativeness, selection bias, data quality, cost, and signal decay. More data isn't automatically better data. In finance, better data means relevant, timely, reliable, lawful, and tradable information. One of the most important AI applications in investment research is natural language processing, often called NLP. NLP refers to computational methods for analyzing text and speech. In finance, NLP can process annual reports, quarterly filings, earnings call transcripts, press releases, central bank statements, analyst reports, news articles, and market commentary. NLP can classify text as positive, negative, uncertain, risk related, litigation related, supply chain related, or macro related. It can extract company names, people, products, events, financial metrics, dates, and strategic themes. It can also identify topics such as demand weakness, cost pressure, pricing power, regulation, capital allocation, or competitive threats. Another useful NLP task is change detection. Instead of reading a document only in isolation, AI can compare current language with prior language. This helps analysts notice new risks, remove disclosures, changes in tone, or shifts in management emphasis. Sentiment analysis is one common NLP application. It attempts to measure tone, optimism, pessimism, uncertainty, or emotional content. But sentiment must be interpreted carefully. Positive language isn't the same as strong fundamentals. Negative language may already be priced in. Uncertainty may indicate genuine risk, but it may also reflect complex disclosure requirements. Earnings call analysis is especially useful because calls include both prepared remarks and analyst questions. Prepared remarks show what management wants to emphasize. The question and answer section often reveals what investors are worried about. AI can speed up transcript review, but the analyst must preserve context. In finance, words can have specialized meanings. Sentiment isn't a substitute for valuation. It is evidence that must be connected to cash flows, discount rates, risk, and expectations. AI-assisted equity research isn't about asking a model to decide whether a stock should be bought or sold. It is about using AI to support the analyst's research process. A strong equity research process separates facts, assumptions, forecasts, valuation, risks, and catalysts. AI can help organize these elements. It can summarize filings, extract business segments, identify revenue drivers, detect margin pressures, compare management commentary over time, summarize analyst debates, identify peer companies, and organize risk factors. But the human analyst must verify every claim. AI may produce language that sounds confident but is unsupported. It may miss important context. It may confuse source evidence with interpretation. It may also summarize a document correctly while still failing to identify what matters for valuation. AI can also support screening and decision support. A model may rank firms by valuation characteristics, profitability, momentum, quality, risk, liquidity, earnings revision patterns, or text-derived signals. The key point is that a ranking isn't an investment thesis. It is a prioritization tool. A good AI screen should lead to better questions. What variables drive the score? Is the score stable? Has the signal worked across different market environments? Is it concentrated in one industry or risk factor? Can it survive transaction costs? What evidence should a human analyst review before acting? The best AI-assisted research process produces not only an output, but also an evidence trail. It helps the analyst move faster, but it doesn't remove the need for verification, interpretation, valuation, and accountability. Let's now move from research to portfolio construction. Portfolio construction translates forecasts, risk estimates, constraints, and investor objectives into portfolio weights. AI can help by improving expected return estimates, forecasting volatility and correlations, identifying risk regimes, supporting scenario analysis, and suggesting rebalancing trades. Conceptually, the idea is simple. The portfolio manager wants attractive expected return, controlled risk, reasonable turnover, and compliance with constraints. But portfolio construction isn't only a mathematical problem. It is also a governance problem. The manager must decide which forecasts deserve capital, which risks are intentional, which risks are accidental, and whether the final portfolio can be explained. One major challenge is forecast uncertainty. Expected return forecasts are noisy. When a model produces precise-looking estimates, an optimizer may take extreme positions if constraints are weak. AI can make this problem worse if the model gives confidence without stability. For that reason, robust portfolio construction often uses position limits, sector limits, country limits, currency limits, factor exposure limits, turnover controls, liquidity constraints, stress tests, conservative assumptions, and human review of large or unexpected trades. The practical question isn't whether the model forecast is perfect. The practical question is whether the portfolio remains sensible when the forecast is wrong by a realistic amount. That is the heart of robust AI-assisted portfolio management. Use the model, but don't surrender judgment to the model. AI also plays an important role in trading and execution. Once a portfolio manager decides to buy or sell, the trading problem is implementation. The trader must complete the order while managing market impact, timing risk, liquidity, and transaction costs. AI can support execution by forecasting short-term liquidity, estimating market impact, choosing execution schedules, detecting unusual order book behavior, routing orders across venues, and monitoring real-time risk. In fast-moving markets, these tools can be valuable because execution quality can meaningfully affect investment results. But speed creates responsibility. A faster system can also transmit errors faster. A data problem, model bug, or misinterpreted signal can generate incorrect orders before a person notices. Therefore, AI-assisted trading requires strong controls. Important controls include order size limits, participation limits, price collars, volatility checks, pre-trade compliance checks, independent model validation, real-time monitoring, alerts, audit trails, post-trade transaction cost analysis, and clear procedures for stopping or overriding the system. The goal of AI in trading isn't simply to trade faster. The goal is to execute decisions in a way that is cost-aware, risk-aware, compliant, and consistent with the investor's mandate. We should also mention robo-advising. Automated advisory systems can help with client segmentation, portfolio monitoring, rebalancing, tax-aware recommendations, and plain language explanations. But automated advice still requires governance. Recommendations reflect assumptions, product menus, questionnaires, fees, constraints, and disclosure practices. Automation doesn't remove responsibility. In finance, accountability remains essential. Let's finish by discussing generative AI, model validation, explainability, and responsible use. Generative AI can produce summaries, tables, code, draft memos, explanations, and research outlines. In investment workflows, it is most useful when it is grounded in source documents and given a clearly defined task. A sound generative AI workflow separates retrieval, extraction, and analysis. First, identify the relevant source documents. Next, extract facts, passages, metrics, assumptions, and dates. Then, interpret the evidence and decide what it implies for valuation, risk, portfolio fit, or trading. Prompting matters. A weak prompt asks for an unsupported conclusion. A stronger prompt specifies the role, the source boundary, the task, the output format, the verification requirement, and the restrictions. In investment work, we shouldn't ask AI to invent data, fabricate citations, or provide unsupported recommendations. Model validation is equally important. AI models can fail because of look-ahead bias, survivorship bias, data leakage, overfitting, multiple testing, regime change, and ignored transaction costs. A strong validation process asks whether the strategy would have been possible, implementable, and sensible at the time, using only information available then. Explainability also matters. Investors, clients, committees, traders, and regulators may need to understand why a model produced a result. Model risk arises when a model is wrong, misused, misunderstood, or applied outside its intended environment. So here's the main lesson. AI can help analysts ask better questions, process more information, and test ideas more efficiently. But investment decisions still require judgment, context, economic reasoning, and accountability. Thank you for joining me today.